Have you heard to stay away from fixed index annuities since they are too complicated and have too many fees?
Well, in this video, we're going to lay it all on the table, no sugarcoating it, and we're going to first discuss the 5 huge disadvantages first before discussing the advantages.
Now, most annuity salespeople like to focus mainly on the advantages, but barely touch on the disadvantages.
And at the end of the video, we'll also discuss how to compare all types of annuities and their income riders. Hi, I'm Kai.
And I'm Ann, where our goal is to assist people in all 50 states to retire healthy and wealthy.
So how does a fixed index annuity work? Well, first, a quick recap on fixed index annuities. To be clear, fixed index annuities are not variable annuities. Variable annuities typically have fees around 2% to 5%. Plus, variable annuities have market risks, whereas fixed index annuities have no market risk.
How does a fixed indexed annuity work? Well, your money is sitting in a cash account, like a savings account. That's why it's fixed. Also, you will earn a minimum floor, much like a savings account. And depending on the current interest rates, your floor could be anywhere from 0% to 5%.
Well, remember, your money is also not invested in the index. It's in a cash account, much like your savings account. Instead of getting a flat interest rate, though, you'll be getting a credit from the performance of the index. So instead of investing your money in the index, buying shares, selling shares, you're just getting a credit based on how it performs.
Yes. And of course, the insurance company is investing your money, just like the bank is investing your money in your savings account. However, the insurance company is making money on their own investments.
Typically, around 70% of their investments are in bonds, and around 10 to 15%, by the way, is in mortgage loans.
Right. So the insurance company is not making all their money from the index either.
Now, therefore, if the market goes down, you don't lose your money. And the insurance company, they won't lose their money either, since they are doing their own investments. However, if the index goes up, you'll get a credit based on the performance of the index.
Now, they might use a small portion to buy options of the index, but the majority of their investments are in bonds and mortgage loans, as Kai had mentioned earlier. Now, how is that a disadvantage then?
Now, we all know that every advantage has a disadvantage, right?
And vice versa.
Right.
So to give you an unbiased video, we'll give you all the disadvantages first, and then reply back with the advantages. Now, if you're enjoying our video, please click the like button, since that does tell YouTube to push this video out to others.
And as a thank you, here's a picture of Gracie trying to escape her dog carrier. Always a rascal. Also, we'd love to hear your comments below regarding the disadvantages that you're about to hear, and maybe what other disadvantages you've come across. And hopefully this video has cleared up a lot of your confusion. Okay, so the biggest disadvantage of fixed index annuities is how the insurance companies limit your earnings, and they do this in 3 ways. First is through what's called a cap. Now, how a cap works is this. Suppose the index went up 10%. If you had a 5% cap, well, the most you would get is 5%.
And the second way insurance companies limit earnings is through a participation rate. Now, here's how participation rates work. Again, suppose the index went up 10% and you have no cap annuity, but the participation rate is only 50%. What would you get for a credit? We're going to do some math. You would only get 5%.
We're going to lose a lot of people again. So 50% of a 10% gain is 5%. Hopefully that wasn't too bad.
No.
Now, the bottom line is you need to make sure to ask what the cap is and what the participation rate is. Now, the third way insurance companies will limit your earnings is through what's called fees and spreads.
This brings us to disadvantage number 2 for fixed index annuities. Be careful of the high fees and spreads. Now, many insurance companies do not charge a fee for their base model, meaning if you choose the lowest cap or the lowest participation rate, the insurance company usually will not charge a fee or a spread.
So there are policies with no fees and no spreads, but there's always a give or take. And what they'll do is typically give you a lower cap or a lower participation rate compared to others. So you need to compare them.
And here's where they get you. The insurance company will charge you a fee or spread if you want a higher cap or participation rate. We've seen fees and spreads at 5% or higher, so be careful. Now, for those who do not know what the spread is, a spread is a fee only from new credits, but never from your principal or past credits you received.
Another disadvantage regarding fees and spreads is that the insurance companies reserve the right to also change the fees and spreads.
Well, so far it looks like people should stay far away from fixed index annuities, right? So why would anyone buy fixed index annuity after all the disadvantages we just said? Well, it's simple. Look for the companies with the highest earning potential by giving you a high cap or a high participation rate with no cap.
And of course, buy one with the lowest fees or spreads. And if you have a choice between the two, preferably a spread rather than a fee. Now, we know that it's not that simple since there are so many different annuity companies out there, especially selling fixed index annuities. That's why here at KCIIS, we represent over 50 different plans to help you find the right company with the highest rates and the lowest fees or spreads.
As a matter of fact, all of our fixed index annuities average between only 0% to 1% in fees. Typically, you're only paying a fee for a higher participation rate, or if you want to have a hybrid pension, and we'll discuss that more shortly.
Now, remember, fees and spreads are not bad if you know what it's for up front. Just like people are very willing usually to pay for a financial advisor.
But we cannot charge a management fee, and we currently choose not to charge a consultation fee either.
We just don't like how the insurance companies and salespeople play games and don't tell you these things up front.
So we're here to represent you and to be transparent with any fine print so there are no surprises.
And what about the insurance companies reserving the right to increase their fees and spreads, though?
Well, first, look for companies that do not have a huge range in their fees and spreads, meaning a carrier might start with only 1%, but their max might be 10%.
Right, versus another carrier where they might just start at 1% as well, but they maybe are maxed out at 5% or even less.
Right. However, here's a more important factor. Does the insurance company have any rate history integrity in writing? Some companies have it and some don't. Does the insurance agent have clients with that same exact plan where they can show the fee or spread has not changed or changed very little?
Good point, Ann. And a quick example is long-term care insurance. Now, many people have been misinformed about long-term care rate increases and were steered far away from buying long-term care because they heard how the insurance companies have huge rate increases as high as 50% and multiple increases as well.
And yes, while this was true for some insurance companies, that wasn't the case for the good companies. Some of our clients that bought Physicians Mutual or John Hancock policies have had very little to no increases for many years.
Right. Our long-term care policy, by the way, that we bought in 2007 has only had one increase, and it wasn't even that big considering that we've had it for almost 10 years by the time they had the rate increase.
Yes. So annuities are similar. You need to find a good company and get proof of their history, not just what your agent or advisor might verbally tell you.
And if the insurance company does not have any proof, can the advisor show you clients that have been on that model, like Ann was saying, for many years without changing their fees or spreads?
Reserving the right to raise their rates is also what most financial advisors or institutions can do as well. So the fact the insurance companies reserve the right is not a big deal in itself. You just need to deal with the right company and find the right plan.
And this is no different than buying the right stock or buying the right real estate. You know, the good plans have very little changes to their fees and spreads.
Exactly. And there are more bad ones than good, but there are always good ones out there.
The third disadvantage of fixed index annuities is the loss of investment opportunities. FIAs are usually pitched as an investment. However, fixed index annuities are not investments. It's an insurance policy. Insurance is to transfer the risk to the insurance company. What risk? Market loss. Well, because it's not an investment, you won't have the same potential as perhaps being in the market.
Just like a bank CD or savings account is also not an investment. The bank uses your money while keeping your money safe with no market risk, but you lose out on potential gains had you invested that money in the market. So what are the advantages regarding the loss of investment opportunities? This fact is only a disadvantage if you are using it for the wrong purpose.
That's right. In one of our other videos, you can click on this card up here, we discussed allocation versus diversification. Allocation has a specified purpose.
Whereas diversification simply means a variety of something, but used for the same purpose.
Right, so it's like saying a spoon is a disadvantage to a knife since it doesn't cut that well. Would that even make sense? Would you even say that? No, rather you would allocate a spoon for its own purpose, right?
Right. We would always have spoons in our drawer for its own purpose and would never compare a spoon to a knife. Therefore, you should always have money in safe accounts like savings and CDs, where you don't care about making it big with market returns, whether in the stock market or real estate.
And now we created a visual called our recession-proof triangle here. We put these spoon type of funds on the top of the recession-proof triangle. Spoon type of funds would be your savings and checkings account, CDs, MYGAs, or they're called multi-year guaranteed annuities, and fixed indexed annuities as well. Now, why the top? Well, the top is the smallest. So typically anything you invest here would be a smaller portion of your investment portfolio because you could make perhaps more interest elsewhere.
So if you are buying a fixed index annuity, your goal should be to protect your principal and you're not concerned about loss of investment opportunities. Investments are like the knives. There are many types of knives. Some are safer than others, like bonds versus stocks. But they all have the same purpose, which is to cut. It can be very effective, but it can also hurt you.
That's right. And when you think about knives, they have their own purpose and they can be very useful. And we can say the same thing for investments like stocks and real estate. Now, we'll put the knives in the middle, the next largest part of the triangle. Why here? Because you have a better potential to have higher gains. So over time, you should make more money than the top part of the triangle.
However, you must be careful with market risks here, whereas fixed accounts like CDs, MYGAs, and fixed index annuities do not.
Now, fixed index annuities with a lifetime income rider or a hybrid pension should not be allocated here on the top or the middle. Now, where would it be allocated? We'll show you that in here in a bit.
So in summary, if you're allocating a fixed index annuity to have potential interest from the market, but your main objective is to not lose any principal, then the loss of investment opportunity is not a disadvantage.
Very good. Now that brings us to disadvantage number 4, time value of money. Now, some fixed index annuities are sold with a lifetime income rider. This is what makes it into a hybrid pension. You're told to give the money to the insurance company early so that you can get a higher payout later.
Your advisor might even say to buy the annuity later when you're ready to start income, so you can capture as many gains from the market as possible now. Otherwise, your money is losing value.
Even those that like the idea of a hybrid pension struggle with the loss of investment opportunities, thinking the value of their money is less while being in an annuity.
This is fair thinking since this is money that you could have invested in the market and thinking it'll grow faster.
And we were actually thinking the same thing before we started to investigate all the other good companies out there, especially before we got into the business.
Yes, true. So regarding the time value of money, does it really make sense to buy a hybrid pension, an annuity with a lifetime income rider? Well, let's first discuss the word timing versus time value of money. Investments are mostly about timing, not time value of money. Well, first, what is time value of money? The basic concept is as more time passes by, the less value your money's worth. Why? Well, inflation. Inflation will make your money lose value every year. Therefore, we are told to invest our money to offset that loss.
But to prove that investments are mostly timing and how that can hurt you regarding the time value of money, imagine you start to invest the money in the S&P, say in 2007, 2008. Then what happened? The market crashed. Well, how many years would it take you to recover? Well, usually most investments will recover from a big recession like that, typically around 3 to 5 years. However, here's the problem. It's called the sequence of returns risk. If you're taking income while the market just crashed, you might never recover and might even run out of money. You can click on this card here or the description below where we made a video comparing two people, Susan and Joe. They both averaged 10% over the same amount of years. They both started with the same principal and they both withdrew the same amount every year. Now you'll see Susan just happened to time the market just right because she didn't get hit with the recession until later in life. But Joe had bad timing and got hit with the recession earlier and almost ran out of money, but he never recovered.
Yes. Yes, I'm sure we've all had some investments where it took not only a few years, but maybe a decade or so to make money.
Or in some cases, it has never recovered. Yes, we still have some stocks that we're still waiting for it to climb out of its hole.
Really?
Oh, I'll fill you in on that later.
Okay.
Anyway.
Another example is Apple. How many years did it take Apple to finally become of anything? Well, imagine if you were 70 and still waiting for Apple to take off.
Well, in that case, you might still be looking for a job at 70 years old.
Right. So don't get fooled that investing will always be better for you in regards to time value of money.
So how does that compare to hybrid pension annuities or the fixed index annuities with the lifetime income rider?
If you shop around the top carriers with the highest minimum payout, remember I said minimum, not hypothetical, then you will find that you would have to grow your money around 7% each year you don't buy the annuity in order to get the same exact payout. Yes, that's per year compounded with no loser years.
Now, here's an example of an online calculator to prove this point. Suppose you want $50,000 per year in income by age 65. Well, you would only need around $360,630 as an initial deposit at 55 years old. However, if you wait to age 64 because you were told to wait and keep it invested in the market, you would need $677,044 if you want the same payout of $50,000 per year, starting at the same age of 65 years old. So if you waited, then you will need $316,414 more, or in other words, you would need to grow your money almost 90% more from age 55 to age 64.
Just to get the same payout of $50,000.
That's 90% growth over that time period, which is just way too much to put on your portfolio. And here's a key point. You might have a big risk tolerance, an iron stomach, but does that portfolio have the capacity or the time to recover if it doesn't go as planned? Sure, maybe when you were 20 years away from your retirement, but not if you're, say, around 10 years or so away from your retirement.
Right. That's a lot of pressure to put on yourself. And I'm sure your financial advisor will not guarantee you that kind of growth.
Especially in writing. So here's another key point regarding hybrid pensions and all pensions. Pensions are largely dependent on life expectancy, current age, and years deferred. Why? All pensions and hybrid pension annuities are insurance policies.
Actually, they're like upside down life insurance policies. Rather than paying you a lump sum when you die, they will pay you a lifetime monthly payment while you're alive.
Right. That's why they use similar actuaries or statistics, and why vesting and deferring the insurance companies earlier is so important. The more time you give them, the higher payout is guaranteed later.
A traditional pension and your Social Security is the same. The longer you work for the union, for example, the more income you will get for life. The longer you delay your Social Security, the more it grows. Social Security grows a guaranteed 8% per year, which many will agree is better than many mutual funds.
Right. So going back to our recession-proof triangle diagram, where would we allocate hybrid pensions?
Well, would you allocate a fork for your everyday utensil? This should be the largest part of your recession-proof triangle.
Or chopsticks.
Or chopsticks, yes. Why? Well, this was the largest part of your triangle during your entire working life. You never built your yearly lifestyle using your investments. Your lifestyle was mainly dependent on the stability of your working income.
So in summary, if your purpose is to replace your salary when you retire with a guaranteed lifetime income, then putting your money in a hybrid pension early is clearly not a disadvantage. Hybrid pension's purpose is to replace your guaranteed working income for your everyday lifestyle that you created.
Right. This is why so many cannot retire early, or they are told to cut back on their lifestyle so they don't run out of money.
And cutting back should not be the case. As a matter of fact, most retirees that retire with 100% pension, they never have to cut back their lifestyle.
This brings us to our last and perhaps the most important disadvantage: marketing gimmicks and salespeople. Like buying anything, a good product can turn out to be the worst product if it was not marketed correctly.
Most annuities are paid a commission, which causes greed and allows room for salespeople, whether it's your financial advisor or an insurance agent. They want to sell you as quickly as possible since they'll make the same commission whether they spend 2 hours with you or 10 hours with you.
Here's another issue. Because it is commission only, they need to make money selling other things. You'll find jack of all trades type of advisors, whether it's a car insurance agent, financial advisor, accountant, tax advisor, life insurance agent, or Medicare agent.
Well, what's the issue with that? Well, even if they are the smartest person in the world, everyone only has 24 hours in a day. If they're spending most of the time in other areas, how much can they really be an expert in annuities? How many insurance companies can they contract with and get to know the nuances between them? Every successful company, like Best Buy, for example, they have dedicated salespeople for a specific department. Even a teacher never teaches more than, say, 1 to 2 subjects at a time.
Right. Even a financial advisor that you would actually think would be an expert with annuities, flat out cannot be a true expert. They might be an expert with the companies that they sell, but that's about it. Financial advisors are also limited to what the broker-dealer allows them to sell.
Some financial advisors, like Fisher Investment Advisors, are not even allowed to sell fixed index annuities. So how can they give the best unbiased advice if they cannot even sell it?
And to be fair, we're not experts in all the stocks and bonds out there, but we are experts in annuities. Now, we do specialize in Medicare and long-term care, but we have teams divided for those products. And we don't sell car insurance or any investment products, only insurance related to guaranteed income and healthcare.
Lastly, you have these multi-level marketing companies that are popping up all over the place.
We are not completely against multi-level marketing companies if you're trying to sell vitamins or Amway type of products, but we are against this for insurance plans. Why? Well, a multi-level marketing company's goal is to recruit and build a downline.
I've never seen a company where you have one person that does it all. They recruit, they manage, they train, they sell, and they take care of customers all at the same time. And then first you're pitched an annuity and life insurance. And before you know it, you're recruited to start a new career.
This is the same problem for all insurance agents or advisors who try to focus on so many product lines. In the end, the person who gets hurt the most is you, the consumer.
You either don't get the right knowledge or you don't get to know the differences between all the different insurance companies.
So what are the advantages of a fixed index annuity if you have to buy through an agent? Well, just like finding the right real estate agent, if you find the right insurance advisor, you will have a true educator, not a salesperson.
I like how you mentioned you want an educator, not a salesperson. So here's another advantage of fixed index annuities when working with an agent. With a financial advisor, you're stuck paying, say, 1 to 1.5% per year, and it's also taken out of your cash value. And if you do your math, you might be paying over 20% to 40% over your life if you were to keep a financial advisor for all those years, not to mention your kids and your grandkids' life as well.
Whatever you transfer or deposit into the annuity, every penny is transferred. Not one penny goes to pay the person selling the annuity, just like buying your car or home insurance.
And that's the same, by the way, for 401k or IRA transfers. And the agent only makes a one-time commission, much like a realtor. But unlike real estate, it never comes from you. It comes from the insurance companies. Yes, just one time. Now, if you're buying a hybrid pension, your income is your net income. No fees, no spreads will ever lower your income that you receive.
So the key is to find the right advisor, and we hope you'll find us to be your one-stop shop for your annuity journey. Here at KCIIS, we don't sell car or home insurance, we do not sell stocks or real estate, and we do not want to be a jack of all trades.
We have people trained specifically on guaranteed income and healthcare products only. Therefore, the person you'll be speaking with will be an expert in that field. But again, we asked a question earlier, how do we compare all the different type of annuities and all these confusing riders?
Well, before we answer that, has this video helped clarify all the confusion? Well, we would love to hear your comments below. If you have any questions, please leave a comment and we'll do our best to reply back.
And if we don't hear from us, don't be shy to call us or email us.
Okay, so as promised, click on this video here to compare all types of annuities and hybrid pensions to see which annuity is best for you.
And click on this playlist here for the entire hybrid pension playlist and how they compare to investments.